Folks, it's now my tremendous pleasure to introduce the speakers for the Hour of Power session. I'll ask them all to come out as I read out their names. We've got Mark Steinert, the Managing Director and Chief Executive Officer of Stockland. We've got Ming Long, Joint Managing Director, Investor Property Group. We've got Peter Allen, Executive Director and Chief Executive Officer of Scentre Group. We've got Stephen Conry, CEO of JLL. We've got Darren Steinberg, the Chief Executive and Executive Director of Dexus Property Group. And of course, our moderator for this morning's first panel is the esteemed Robert Harley, the Property Editor of the Australian Financial Review. Please give them a very warm welcome.
Thank you very much, Mark. Thanks very much. Well, we've done this a couple of times, and there are a couple of congresses, and this is a really top-class panel we've got today. I did a quick calculation, and there's 75, these guys represent $75 billion worth of real estate investment, and there's another $30 billion worth of pipeline, particularly housing and shopping centres. So there's a lot of depth and knowledge and sitting here, and I hope we'll get some conversation going. So I'm hoping we'll get some questions. But I'd just like to start very quickly with probably the big pressing question of the day, and that is, are asset prices overvalued? Have assets with all the money chasing them run ahead of the fundamentals? And we had a piece on this the other day, Mark. We had some comments from Stockland, but you might like to give us your view.
Sure, thanks, Rob. Look, I think overall it's definitely a hot, warm market, but I don't think it's over the top yet. I think most sectors are going to see additional cap rate compression, another 50 to 100 bips, on the basis of where long bonds ultimately end up. But you'll get some volatility at these levels. You'll get more volatility. And you've seen that even the last week with the way the REITs have traded, just with bonds backing up a little bit in the US.
And Ming, so what's your view?
Not even close. So I think when you have a look at, even with that volatility that Mark was talking about, the bond yields coming back, we're still seeing record spreads against the bond yields for real estate. So I think there's still a way to go. I think if you have a look at expectations of return from investors in real estate, long-term real estate around the world, they still want more. So I think there's ways to go.
So expectations, so their returns, the returns they're looking for are actually quite low by...
Lower returns expected from investors around the world.
And Peter, you may well be a seller. What do you expect?
Well, I don't know whether we're a seller or not, but Rob, in terms of property, I think certainly for retail real estate, quality retail real estate, the total long-term returns from a risk-adjusted point of view are very strong. And I think that when you compare that to other alternative investments, whether that's bonds, equities, etc., then retail real estate and all real estate, I think, is highly attractive.
Yeah, and you're the agent. Should we be buying or selling?
Both, Rob. The market's not too hot, Rob, but thanks for bringing it up because people will start talking about it now, but it's market by market assessment, asset by asset. There's still some enormous opportunities available, so there's a way to go yet.
But there would be some markets which might be too hot.
Yeah, hot because there might have been a good deal or two recently, but if that asset was on the market tomorrow, it'd sell again for the same price or a bit more.
And Darren, because we've seen a wind back in the trusts over the last week or so. I mean, does that point to the fact that we just went too far?
I think let's park the trusts for a second and just come back to fundamentals. And the fact is that Australian real estate traded at a premium over other global cities for many, many years. And part of the reason behind that was our interest rates were a lot higher. So what you've seen now is capital is moving all over the world to where those opportunities are. You've seen interest rates come back in Australia to create this spread that Ming was talking about. And so all this overseas capital is seeing our real estate as being quite cheap. And so what you're seeing is you've got many pools of capital coming in to purchase the real estate, and our yields and our return expectations are coming down. So far from being cheap, you've got you have many people with lower return expectations that have been here before. So therefore, our real estate, may have further to go. It may get it may get even, it may be seen as cheap today.
Yep. Well, you're going to be selling a few things, aren't you?
Yeah, I think it, as the guys have said, it always comes down to asset specific. So you may have assets that you think your team can no longer maximise, while other people will see it as value. Yeah. And that's all those views that make a market.
Yeah. Well, the essence of this is then between the capital markets and the broader economy. And I think the view on the broader economy is quite mixed. I mean, Ming, what's the outlook for the world economy? What are you working on for a world economy?
Look, I think we're still trying to digest a lot of the sort of after effects from the financial crisis. So, you know, the expectations, you saw the OECD come out, I think, a couple of days ago and downgrade global growth. But I think generally speaking, we're seeing the US stabilise. It'll be interesting to see whether that momentum can be maintained. I think there'll be issues still coming out of Europe. And China, you know, whilst we sort of hear mixed messages, is it sort of slowing down, is it not, etc., I think they will still get to the 7%, 7.5% growth. Japan, they've got really fundamental long-term issues to work through. What I am concerned about is that a lot of the issues we saw through the financial crisis have not really been resolved. Even the issues around Europe, having that single currency, etc., and the level of debts that we see through those countries, they have not really been fixed. So when I look at that sort of landscape and then translate that back into Australia, I think Australia has still a lot going for it. You know, we still have higher levels of interest rate. We can reduce that if we need to, and our fiscal deficit is not out of control. So I think the outlook for Australia is still good. I'm not expecting it to get to, you know, sort of 3 to 4% sort of levels of growth. We're talking about 2 to 3% levels of growth within Australia. Very sustainable, very steady, I think, sort of coming through. There will be bumps, though, as we wind out, I think, the investment in the resources sector. So I think volatility will definitely be a theme. But generally speaking, I think the outlook for Australia is fantastic.
So Mark, I mean, we keep talking about worse to come as the resources boom really tapers to an end. What are you looking for in the Australian economy?
Oh, look, I think our view from here, Robert, is that the transition in the economy so far has been smoother than many commentators predicted. If you go back only 18 months ago, probably 3 or 4 of the most significant economists in the country were saying there's a reasonable chance of recession. I think that's well and truly in the background now. And so I think around trend growth, just maybe slightly below, so let's call it 2.75 to 3% GDP growth. And we've got a very dollar-sensitive economy, you know, so what's going on at the moment? You know, tourism numbers up 8%, they're spending $30 billion a year. Dollars come off even more in the last few days, that'll help that. Offshore student numbers are up 40%, food production's up, energy production is up. You know, ultimately, healthcare provision, great place to come and get an operation if you live in this region. You know, so the migration obviously still running over 200,000. All these things combined, you know, will grow the economy. The economy has broadened out. That is good. That means you'll see, you know, improving consumption, better retail sales numbers. That's good for industrial, it's good for office, it's good for real estate.
So you're not worried about the iron ore price, which we all seem to be obsessed by?
No, I mean, the iron ore price obviously affects royalties, but at the same time, volumes are up dramatically. So that's an off-put. And the thing, I can't remember the exact sensitivity, but remember iron ore is priced in US dollars, so Aussie dollar depreciating, that actually helps mitigate some of that offset also. But you know, it's like mining jobs are not the be-all and end-all, and the iron ore price is not the be-all and end-all either.
Yeah, and so Peter, what are you seeing in the malls? I mean, we're still talking about how tough it is out there. What are you seeing?
Yeah, I think that, as Mark and Ming said, I think that, you know, we're seeing that in the longer term we're going to have, you know, 2.5%, 3% GDP growth as far as Australia. That's what we're looking at in terms of forecast. Where that translates in terms of the malls, you know, we've certainly had now 13 months of consecutive growth in retail sales. And I think it's really important that we consider how well we have gone through the GFC as a country. And if you look back, the United States after Lehman's collapsed, retail sales dropped 15% overnight. Basically, the US consumer went on strike. And really, it's taken some 5 years to get back to those similar levels, when, in terms of the last 3 years having 5% plus growth in terms of retail sales. Whereas Australia, during the GFC, retail sales were still growing. They didn't go backwards in terms of our centres. We're now starting to see real positive growth in terms of, somewhere around 2.5–3% on average across our portfolio. And we see that that's going to continue. The consumer themselves are not broke. And when you look at unemployment, you look at wage growth, etc. So the consumer's not broke. I think that the issue that we have, certainly as a landlord, as an owner of retail real estate, is ensuring that we've got the right products, the right retailers, the right leisure activities in our centres in terms of where people are wanting to spend money.
So go on,
Rob, I think the underlying problem at the moment is confidence. I think if you actually cut through all the noise in the papers, like every time you open a paper, there's a big black headline of all the negativity, and then any positive thing is sort of page 20 in the very small print. Because as you know, good news doesn't sell papers. And you look at all the statistics, whether it be consumer confidence or business confidence, there's so much data flowing around, it's so erratic, but the trend tends to be up. So I think if we can get more confidence back into the economy, and that will translate into better retail sales, people will save a little less, and there'll be more people confident enough to invest in their businesses, which will see more activity.
So where do you get the confidence from?
Well, I think it starts with big business, doesn't it? It starts with us, putting money into projects, which many of us are doing. We're certainly seeing, particularly in the Sydney CBD, a number of businesses taking new leases, for example, and Ming's probably seeing it in her portfolio as well. We're seeing it with overseas retailers coming into our shopping centres who, they're saying on a global basis the Australian economy is actually going okay.